Welcome to the Vaughan Nelson podcast. Today is the third quarter 2025 Vaughan Nelson International Recap. And with me today is lead portfolio manager Adam Rich. Welcome, Adam.
Thanks, Dan. Great to be here.
All right, Adam, let's dive right into performance. Can you give me a quick recap on the strategy performance this quarter, both relative to the benchmark as well as highlighting a few positives and some challenges that you faced?
Yeah, the strategy outperformed the benchmark by roughly 400 basis points this quarter. The outperformance came mainly from stock selection, especially in companies that continue to allocate capital with discipline and are improving return on invested capital. That said, market leadership was narrow, and a few areas dominated index returns, particularly those tied to AI and China AI momentum, which we approached more selectively.
Any main themes, market forces that shaped results? Anything that you can describe about how they cut, kind of both ways for the portfolio?
Yeah, the two themes really shaped the quarter. The first were global markets were driven by renewed enthusiasm around AI and data infrastructure. Companies tied to semiconductors, high end hardware, and AI supply chains rallied sharply, and that benefited us since we've owned several high quality companies in the space, including Fujikura and Monolithic Power Systems. The second theme, though, was the China AI trade, which influenced sentiment across the broader index. We saw a wave of capital flow into large China and regional tech companies as investors chased the AI narrative. We were underweight this theme, and that was a detractor. But our framework suggests that while spending is rising, returns on that spending have been falling for years. Massive reinvestment into AI infrastructure isn't necessarily translating into better return on invested capital. It's often absorbing capital rather than creating value. So while the cycle may create short-term tailwinds, we think the long-term payoff will be uneven, and that influenced how we position the portfolio.
And perhaps getting into some company specifics, any companies or industries that contributed most to performance, anywhere that you saw some setbacks?
Yeah, our top contributors were Fujikura, Monolithic Power Systems, and Grupo Mexico, all companies reinvesting counter-cyclically into high-end or high-return opportunities. Fujikura continues to expand next-generation fiber capacity ahead of rising data demand. Monolithic Powers benefited from strong AI-related component growth, and Grupo Mexico remains disciplined in copper expansion.
Any specific sectors, regions, holdings that proved to be a little bit more difficult in the third quarter? And on the flip side, anything that perhaps offers some brighter spots despite those challenges?
Yeah, the main detractors were WiseTech Global, Mercado Libre, and ASML. WiseTech and Mercado Libre both faced near-term execution challenges after strong runs, and ASML was impacted by their narrowing end market and shifting expectations around semiconductor equipment orders in China. And I think it's important to note that we sold ASML at the wrong time, and the stock really rallied after we sold it.
Let's tie this back into capital allocation framework, something we discussed on a few of our podcasts here. How the capital allocation framework guide any of your investment decisions in the third quarter? Any cases where it led to avoiding some pitfalls or potentially capturing some opportunities?
Yeah, the capital allocation framework guided us towards companies and industries where capital is being deployed with discipline and high return potential, and away from those chasing growth without clear returns. It's what's allowed us to stay invested in semiconductors, materials, and industrials, sectors where ROIC trends are improving, while trimming exposure to areas where spending outpaces profitability. That discipline helped us participate in upside while managing risk in the most speculative corners of the market.
And how about anything that you noticed, kind of shifts in how companies or industries or countries were beginning to allocate capital? Any risks or limitations that those shifts present for opportunities?
Absolutely. Globally, we're seeing a reacceleration of investment from digital infrastructure and manufacturing reshoring to energy projects. But the key question is whether these investments are creating value or just expanding balance sheets. The AI buildout is a great example. We're in the middle of one of the largest reinvestment cycles in history with enormous spending across data centers, semiconductors, and power infrastructure. Yet, when we analyze returns through the capital allocation framework lens, we find that return on new AI-related capex are flattening, and in some region, particularly China, declining. So while AI is a powerful secular trend, it doesn't automatically equate to better ROIs.
All right, moving over to some activity here. Any new positions you added this quarter? Any risks that you're identifying in those names as you start to scale them up?
Yeah, we were pretty active this quarter. We added 8 new names: Rizona Holdings, Wheaton Precious Metals, SK Hynix, BHP, International Container Terminal Services, AstraZeneca, Aker BP, and Rheinmetall. Each was selected for their disciplined reinvestment programs identified by the capital allocation framework. For example, SK Hynix is investing countercyclically into advanced memory at a time when the industry, Samsung, is cutting. That's the kind of investment that typically drives future ROIC improvement.
All right, very good. And how about exits? Any meaningful exits this quarter? Any positives that you had to give up in order to reduce some exposures?
Yeah, we sold Embraer, ASML, and a few others where the capital allocation framework signaled deterring capital discipline and more crowded industry dynamics. For example, with Embraer, Boeing is really starting to ramp up their production, which will have an impact on the whole industry. In other cases, valuation had already priced in strong growth, leaving less margin for error. And we did redeploy that capital towards companies earlier in their reinvestment cycle where returns on capital are still rising.
All right, let's wrap up with some outlook. How's the portfolio currently positioned? Any vulnerabilities that come with that positioning?
Yeah, we're still leaning into companies investing countercyclically. Semiconductors and materials are 2 key highlights there. And these are areas where we see real ROIC improvements. The main vulnerability is if global growth slows sharply, or if the AI-related names cool faster than expected. To balance that, we are increasing exposure to healthcare as policy becomes more clear. This is giving us more confidence in the ROIC outcomes in the industry.
All right, last question for you today. Just looking ahead, where do you see the biggest opportunities and any risks that would potentially offset those gains?
Yeah, we're optimistic about companies and regions redeploying capital with improving returns, especially across Latin America. But we're also realistic. The AI investment boom is creating both winners and traps. In some areas, like the US and Japan, companies are building infrastructure with measurable productivity gains. In others, particularly China, rising capex hasn't led to better returns, and we don't expect that to change soon given structural inefficiencies. So our focus remains on identifying where capital is creating value, not just being spent. That's the heart of the capital allocation framework, finding early signs of improving ROIC while avoiding overinvestment cycles that can erode future returns.
All right, good deal, Adam. And with that, we will move to returns. In the third quarter of 2025, the Vaughan Nelson International Strategy returned 10.72% gross, 10.45% net, versus the MSCI ACWI ex-US at 6.89%, which brings the year-to-date returns for the Vaughan Nelson International Strategy to 41.21% gross, 40.19% net, and that's against the MSCI ACWI ex-US at 26.02. Over the past 1 year, the Vaughan Nelson International Strategy has returned 37.49% gross, 36.16% net, and 16.45% for the MSCI ACWI ex-US index. And lastly, since inception, the Vaughan Nelson International Strategy has returned 30.01% gross, 28.74% net, and the MSCI ACWI ex-US has returned 17.31%. With that, that's a wrap on the third quarter. So thank you very much, Adam, and we'll see you again here soon.
Thanks, Dan.
The views, information, and/or opinions expressed during this podcast are solely those of the individuals involved and do not necessarily represent those of Vaughan Nelson and its employees. Vaughan Nelson does not verify and assumes no responsibility for the accuracy of any of the information contained in the podcast. The primary purpose of the information, opinions, and thoughts presented in this podcast is to educate and inform. This podcast, or any podcast in the series, does not constitute professional investment advice or services, and any reliance on the information provided is done at your own risk. Past performance is not an indication of future performance. By accessing this podcast, you acknowledge that the entire contents of this podcast are the property of Vaughan Nelson or used by Vaughan Nelson with permission and are protected under U.S. copyright and trademark laws. Securities discussed within this podcast may be held in the Vaughan Nelson strategies.